And we're live. Welcome back, everyone, to CapitalCosm Live. And you read the title. They're doing something strange to the silver price, but that's no surprise to you guys. But this time, we have receipts. But before we get started as well, nothing in this video is financial advice. Everything I say is just my opinion. Be sure to check with your own financial advisor and do your own due diligence. So, with that said, also be sure to hit that like and subscribe, guys. If you're enjoying these live streams, if you're enjoying these videos, these interviews, all of it, it really goes a long way in helping to support the channel. So hit that like and subscribe. I would really appreciate it. And also let me know, can you hear my voice clearly? Give me a 1 in the chat. My audio is coming in loud and clear. And let's just dive right into the nitty gritty here. We've got this chart of the silver price, and what we're looking at here, I mean, do you see what I see? I'm actually going to make it a little bigger. Do you see what I see? I mean, this is as clear cut of a line as can be. Do you guys think this is natural? This resistance line was formed in the dead of night last night on Friday. And anytime we tried banging our head above this 74.50 level, it was like a force field. We just couldn't get through. Really odd stuff ongoing here. But we all know what's going on. They're panicking. There's all of these talks we've been hearing about, reverse repos in the middle of the night. They've been dumping billions of dollars into the reverse repo. We've got the charts here to talk about as well. This is across total securities purchased just the day before New Year's on December 31st. $74.6 billion dumped into the repo market. So they're injecting the banks with $74.6 billion. And, I hear people saying that this is kind of like this window dressing to cap off the year. This is year-end window dressing. But the problem with that is, and maybe I'm wrong here, but if I take a long view of this chart, I don't see $74 billion being the common denominator here for every year. Every year end, it's pretty much barren. We only see these spikes right before something major happens. The last time we saw these spikes was just before C19, the disease. And we saw a big spike here in November, and then we all know what happened in early 2020. And then we also saw these spikes in the repo market as well in 2000, before 2008, and we know what happened there. There was the GFC, the great financial crisis. And then we also saw it right before 2000, or right on 2000, or as far as this chart goes, this only goes back to 2000. And yeah, so that's the common thread. Anytime we have these major events, these overnight repo injections start popping up. So I think that there's definitely something going on. I don't buy the overnight year-end window dressing story. And again, if I'm wrong, let me know in the chat if I'm missing something, because I don't see anything of that volume popping up on any other years except the years right before crisis. So there you go. So let's go back to the silver chart here. So they're definitely panicking. And it's as clear as day. But let's go ahead and check out where we closed today. We headed down to a low of 71.43, and we closed the day off at 72.82. And so they've been raising these margins requirements, and they've raised them twice now. And I believe now they're at 30% cash. And so eventually it's just going to get to the point, just make the entire silver paper market a cash market, a 100% cash market, and be done with it. But the fact that they had to raise it twice, that tells you that they underestimated the demand side of silver. I think we're overpowering them. And the demand is too big to rig, essentially. They had to go back to the drawing board and raise the margin requirements for a second time. Now, they can do it for a third time, but as you'll notice, it's becoming less and less potent each time. And they can only raise it so much. Once they raise it to 50%, it's effectively an all cash market at that point. There really isn't much difference between a 50% margin requirement and a 100% margin requirement. I mean, you're just going to go all cash at that point. Who would dare go leverage long, under 100% at that point and get caught off sides? No one. So it's only a matter of time. This is a speed bump, in my opinion. Let me know what you guys think. But I mean, we closed out the week strong. We closed out the year strong. Let's go ahead and take a look at the yearly candlestick. I'm going to put it on a 12-month candlestick and check that bad boy out. It is a thing of beauty. This candlestick was the second biggest yearly gain in silver outside of this one right here in 1979. So we are literally making history, guys. It is bonkers. And one thing I'll tell you, I think a hallmark that we're still somewhat early in this phase is that you look at these prior silver bull markets, and what you'll notice is, in so far back as the 60s, because before the 60s, you don't have any candlesticks. But around the 60s or so, the last big, or the last two big silver bull markets, the first one being in 1972, starting in 1972 and drawing all the way out until 1979 or 1980, it had 1, 2, 3, 4, 5, 6, 7 green candlesticks. Now, there was one red candlestick in between. That was kind of a break. But it was 7 out of 8 years were all in the green. Now, this time around, you can make the argument that the bottom is somewhere around here, or where we broke out from this 40-year cup and handle pattern. And you can make the argument this may be the first candlestick of the bull market. You also see it happen here in 2000. You had 1, 2, 3, 4, 5, 6, 7, 8, 9 candlesticks. And you had one red candlestick in between. So do we get a red candlestick, this coming year, or this year, I should say, to kind of help us catch your breath? I don't know, but more often than not, the probability says that you're more likely to close out the year stronger than you started it, based off of these candlesticks. You could also make the argument that the bull market in 2000 actually started in 93, but I wouldn't say that's the case, because you actually had a move up here, but then you kind of arched down. So I would say that the bottom was somewhere around here. And so this time around, I would also say that the bottom was, you could maybe make the argument that the bottom was in 2023. Or you could say that it started right at the cusp of this cup and handle, in which case we literally just started the bull market. In any case, if history is any guide, we've still got a long ways to go. None of these bull markets ended in just 1 year of a blow off top. If it did end this way, it would be very strange. It would be an anomaly in history. And what we're witnessing today, I might add, and I'm going to switch it over to a line chart, is if you look all the way out, you'll notice, and I think I touched on this before, maybe in one of my interviews or my live streams. It's all getting kind of hazy. I can't remember when I said stuff, but whatever the case is, this is a chart of silver going back to the 1800s. And you'll see we've been in this zone, bumping our heads back and forth on this resistance line, on the support line. And now we're about to hit this resistance line, or you could maybe say that we already have, depending on how you draw it, right? So we're getting awfully close to it. And this coincides with the fourth turning. We're in a fourth turning cycle. It happens once every 80 to 100 years. We're seeing a reset in the monetary system. So we may, in fact, break free of this 100-year plus resistance line. We broke free from it in the 1980s. We came back, retested it, and we fell back into the swing of things. But I would contend, as have many others, I'm not breaking any new ground here by saying that this silver market is unlike 2000, early 2000 to 2011, and unlike the one in the late 70s. But there are multiple developments, multiple trends kind of crossing over each other at the same time. You have the fourth turning trends. You have this. You obviously have this trend line. You have the 10-year yield breaking out from a 40-year trend line. You also have we could chart this thing versus the S&P, and I think you'll find some startling developments there. So here's silver relative to the S&P, and this is on a log chart. But if you look at it from a linear scale, you could say 3 humps right there. 1, 2, 3, and typically the fourth one is a breakout. But let's go ahead and switch it back over to a log scale, because we are seeing price changes in terms of magnitude, which makes a log scale more appropriate. But be that as it may, you could say we're looking at something like this too. Boom. We're right on the cusp. Right on the cusp of this 40-year resistance line in silver relative to the S&P. This basically implies that silver is or has been outperforming the S&P and is about to break out and outperform it even more so. So capital doesn't vanish. Capital is capital. There's a pool of capital, and it goes from one sector to the other sector. One sector gets overweight, another sector gets underweight, and capital just goes from overweight to underweight, and then from underweight to overweight, and that's how it works. And we've been overweight the S&P, the broad market, equities, etc. And we've been underweight commodities, precious metals, energy, all that other good stuff. And it looks like we are due for some sort of capital reallocation. We've been ultra heavy equities and underinvested commodities and metals and energy. And typically what leads the way is precious metals. Precious metals are your canaries in the coal mine. And so we're witnessing something historic here. And they're going to, look, guys, they're going to pull up, they're going to throw everything in the kitchen sink at this thing. We've already seen it with the CME margin hikes. These guys have 7 ways to Sunday to slow down, to try to slow down the train. But I think, look, I mean, their limitation is that they only can control the paper market effectively. Now, everything is based off of the paper market, yes. But I've been trying to make this point on my show lately, and it's once the paper market becomes so disconnected from the physical market, it's no longer anchored to reality. If the physical market says one thing and the paper market says something drastically different, at what point do people stop caring about what the paper market says? At what point do they stop pricing in their precious metals, based on the paper price, and just start pricing it at the delivery price? I think you guys saw that today, my interview with Alistair McLeod. We also talked about it in my interview with the market sniper, Francis Hunt and Eric Jung. We did a panel that should be posted tomorrow on YouTube. It should be posted later tonight on my Substack if you're interested, if you want to get a head start on that. Link to my Substack should be below, I believe. If not, it's capitalcosm.substack.com if you want to subscribe there. But we touched on that topic with those two as well. So so many things are happening, and it's fairly captivating. And if you'd like to, oh, by the way, guys, if you'd like for me to read your comments, feel free to leave a super chat. I will be reading all the super chats. I can't read every single comment that comes through, but I will be making an effort to read the super chats. And I just want to give you guys also another update on retail interest when it comes to gold and silver. So here we've got Google Trends data on gold price in blue and silver price in red. This stretches all the way back to 2004. And as you'll notice, interest in both of these search terms has gone up to all-time highs. So that does imply there is retail demand. It's undeniable now. I've been doing this show now for 3+ years, and I've always talked about no one talks about gold and silver. It's still fairly siloed amongst a small group of enthusiasts, but it appears that we're in the very beginning stages of breaking out into the mainstream zeitgeist. It's not fully broken up, but it's just starting. And so I also want to look at the past. Let's look at the past 30 days, see how things have been affected over the holiday season. In red, you have silver price. So silver has begun gaining traction amongst the retail crowd. We saw a big spike in that. It overtook gold over the holiday season. And let's zoom out a bit more to the 90-day view. And yeah, I think this is the first time it's overtook gold in a long time in terms of certain, maybe ever. 12 months. Let's look at that. Yeah, so silver is here in red. And from a 12-month view, it's just starting to shoot up. Gold had its time in the sun in mid-October. And it came down a bit, but it's been elevated since. So there you go. There is interest from the retail crowd when it comes to gold and silver. Now, I also want to pull up silver stocks. And silver stocks are nowhere near as you'll see here. So silver stocks is in blue. If I type in silver price in red, far over, like the term silver stocks on Google represents about 1% of the volume of people searching for the silver price. So we're still super early when it comes to the silver stocks. If I type in gold stocks, let's see what it gives us. And we saw a spike in people searching gold stocks in between July to October, and it's stayed elevated since then. But we've recently seen an interest begin to form in silver stocks, and this is in the United States. Let's look at it worldwide, and there you go. It's interest in silver stocks worldwide has begun to outpace gold stocks. Now, gold stocks had a pretty strong period here in August and October. And if you look at, let's say, GDX, and if you compare it with SIL, the silver stock ETF, I'm going to say same percent scale. And let's look at it on a 1-year time frame. Oh, they're actually neck and neck. 6 months. Yeah, so they're actually neck and neck. But compared to the price of gold, GDX is up more so than SIL. So, for example, if I type in gold here, XAU USD, you'll notice gold is here in blue over the last 1 year. Gold is up 62%. So gold stocks are up 147%. Now, if I change it to SIL in the green, and if I look at just the price of silver, you'll notice there really isn't much outperformance in silver miners relative to the price of silver. So I think that's what this is telling us. I think, it may be time. The time may have arrived for the silver stocks. I guess we'll have to wait and see. I think we have a super chat from Blue Water Stacks. My friend, thank you so much. Happy New Year, and thank you. No, thank you. Thanks for watching. I appreciate the super chat. So, yeah, guys, it is getting wild. And so before we continue on, I'd like to point out that if you are interested in adding into your silver stack, consider becoming a member at the Bullion Standard Pro. It's kind of like a Costco, Sam's Club model. In this case, you pay $35 a month, and you get access to wholesale or near wholesale pricing on your gold and silver. For example, in this case, you can buy a silver American Eagle for $77.96 right now. Compare that to $86.15, which is the average retail price, saving you $8.19. Now, if you buy 20 of these bad boys, you can buy them You can buy 20 of them for $77.96 as opposed to $86.06 average retail price, saving you $162 on average. So it basically pays for itself. So if you are looking for adding more into your gold and silver stack, consider becoming a Bullion Standard Pro member. We have a special link in the description box below. If you use promo code COSM10, COSM10 at checkout, you do get a special 10% off discount on your first month's membership. So be sure to take advantage of that and, lock in the lowest prices you can possible while you still can. So let's go back and take a look at the charts here. Let's see, silver. Go ahead and pull that back up here. And yeah, we've had a pretty strong correction down to 74.56 or 72.82 at the time of this recording. But, I have been seeing some chatter about multi-$100 price points, etc. I think we hit triple digit. I think triple digit silver is a slam dunk here, to be honest. It's my opinion. But I'm going to pull up something here that'll interest you guys. So I'm going to pull up. So I think I may have shown you this before, but for those who haven't seen it, if you look at the gold price here, there's this interesting cup and handle pattern that you see from 2011. It forms here from 2011 to 2020 cup, and then from 2020 to 2023 handle. So if I copy and paste this gold cup and handle pattern, and if I paste it onto the larger silver cup and handle pattern, then I can extrapolate up what my price of silver looks like into the future. And you'll notice there is some correlation to it. Like some of these, like you see this hump here, it corresponds to this hump here in silver. And you had a massive dip here as well. It's not a perfect match, bar none. No, I mean, without a shadow of a doubt, it's not a perfect match, but it gets fairly close. So like you look at the cup, the cup portion of the pattern, like the downward momentum matches perfectly with the silver cup. And, it gets a little disjointed here and there, but it's overall not a bad match. And that takes you to 800 some odd, or I want to say, $750 some odd silver. So we are in a generational run for silver. I don't think there's anyone alive on the planet that was alive prior to the beginning of this trend that we're breaking out of, this 100-year trend. So this is something interesting that's happening. And people they like to look at the two last big bull markets, namely the 2000 to 2011 bull market and the 1970s bull market. But there's also another bull market that everyone seems to have amnesia towards, and that's the 1930s to 80s bull market. And you could say that the late 70s bull market was a part of a larger bull market that started in the 30s, which is what we see here. Could this be? And in the 1930s, that was the end of the previous fourth turning. That was the end of the previous monetary system. And that's when we headed towards the one that we're on today. That was, the creation of the Federal Reserve in 1913, which eventually led to the end of the gold standard and all this other stuff. All that other stuff was just following the trend of fiat currency debasement. And so maybe what we need to do is look towards the 1930s and 40s as our guideline, as our guidepost here. And you see, back then, silver was 28 cents an ounce. And we rocketed higher in a few years from 28 cents to 64 cents. came back down to 34 cents and rocketed all the way up to $2.50, came back down to $1.33, cut in half essentially, and then skyrocketed up to $50. So going from, in totality, I mean, you would have had to ride through some massive volatility here, but in totality, you would have seen 17,000% returns. It's pretty wild, huh? That's 170x or 180x. But that was over a 50-year period of ups and downs. You would have had to hold throughout that entire period. But I think that's the overall trend that we're heading towards now. There are going to be ups and downs. There's going to be down, maybe even 50% corrections and crashes along the way. But I think it's eventually leading us to a very unimaginable. So like the prices we're about to see are unforeseeable. I don't think we can fully comprehend what we're about to see. And a lot of that has to do with the debasement of the fiat currencies as well. So it's not just the price of silver going up, but the demand side of silver, the industrial demand certainly doesn't hurt. It only helps in that regard. So this is an article I want to talk about as well. This is from Zero Hedge. And it looks like it's sourced from the Epic Times. It says, expect the precious metals rally to continue into 2026. So let's go ahead and see what they have to say. 2025 was an extraordinary year for precious metals. Gold, silver, and platinum each outperformed every other asset class, including equities, Bitcoin, which was 2024's best performer, and even indices tracking artificial intelligence, one of 2025's most popular investment themes. Silver and platinum rose by approximately 170% in 2025. Again, that is wild. That is the second largest gain in silver that we've ever seen. Among AI stocks, only Palantir outperformed gold. Oh, and also, I forgot to mention, gold returned a highly respectable 73%. So you see, gold is kind of an afterthought in all of this. And it's fascinating because we spent most of the year with gold as the shining light. Gold was the main character of the year up until the end when silver overtook it. So among AI stocks, only Palantir outperformed gold. And I think Google may have gotten close. Yeah, I think Google got close to beating gold, but didn't quite match up to it. Why such stellar performance from assets once derided by governments as barbarous relics and shunned by investors as outdated? The reason I wrote at the start of last year that we should expect gold to shine in 2025 was because global conditions had fundamentally and perhaps irreversibly shifted. I noted then that the primary factors driving gold prices, including shifting geopolitics, prompting central bank stockpiling, investor concerns over credit worthiness of the U.S. government, and by extension, the dollar, persistent inflation eroding the purchasing power of paper currencies, and widening supply-demand imbalances. So yeah, I mean, you have so many of these trends. It's been a perfect storm. I'll give it that. I mean, you couldn't script something like this, what we saw in 2025, and 2026 looks like it could just be a continuation of that. As a result, we should expect precious metals, including gold, silver, and platinum, to continue performing well in the coming year. Indeed, deglobalization and the continued push towards resource nationalism and the protection of critical materials lend additional support not only to those metals, but also to the broader commodities complex. Again, this is what we're talking about. Name me one war that was deflationary. I'll wait. Can you name me one war that isn't inflationary? Every single war that's ever existed in history has always been inflationary, I believe. I can't think of one that wasn't inflationary. And that's because trade ceases between multiple countries and goods become harder to acquire, and supply bottlenecks create tailwinds in price. And as tension increases, you're going to see more of that. So I think that's what he's talking about. In recent years, central banks around the world have reduced their purchases of U.S. Treasury securities, formerly their largest reserve assets, and have instead been stockpiling gold. You know what? Not to go on a tangent, but I do have a chart to show you guys. I've actually been flaunting this off to a lot of my guests, but I'm going to pull up the gold, and this is actually on topic. I'm going to pull up the gold to copper ratio. Actually, you know what? I'm going to use the gold futures price, gold to copper. So, actually, you know what? Let's do, yeah, gold to copper. Let's see. Actually, no, let's do copper to gold. Sorry, copper to gold. That makes more sense. Sorry, guys. We're doing it live. All right, so copper to gold. You'll see copper's been severely underperforming gold. It's pretty much at a low never before seen priced in gold. Now, next, what I'm going to do is I'm going to overlay the US 30-year yield. And I'm going to put that on a new price scale. And I'm going to make it a more discernible color. Let's make it white. And this is, all right. So you'll notice that the green line and the white line tended to track one another fairly reliably. You could say that there was reliable correlation between the two. And of course, the white line is your 10-year yield. See that trend line here broke out in 2022. And ever since that breakout of the 10-year yield in 2022, it's lost its correlation to the copper to gold ratio. Now, let's think about what this means. And because I have talked about this, and it does tie into the article here. When the copper to gold ratio goes down, that means gold is getting a bid relative to copper. And copper is, what do we call copper? We call copper Dr. Copper for a reason, because it's effectively a proxy for the health of the economy. So when you start seeing gold, an unproductive asset, begin outperforming the economy, that's a worrying sign. And typically what happens when people are fleeing into safe haven assets, they flee into gold and treasury bonds. But in this case, you'll notice, and that's why you see these two lines move in tandem. But ever since 2022, ever since the freezing of the Russian assets and the loss of confidence on the world stage of America's rule of law presence, foreigners are not too trusting of U.S. bonds anymore, which have caused U.S. bond yields to move to the upside, to skyrocket all the way up from near zero to, wherever they are now, almost 5% on the 30-year yield. And so this is a great disconnect. So instead of going into U.S. treasuries as a safe haven asset, foreign investors are fleeing into gold. And that's what they broke. They broke something big in 2022. And we've been dealing with the after effects of it. And here it is illustrated in a chart. Correlation has broken out. And point of fact, it is different this time around. No question about it. No question about it. We have decoupled. There's been a great decoupling at play. So, yeah, let's get back to the article. So, yeah, it says here, in recent years, central banks around the world have reduced their purchases of U.S. treasuries, formerly their largest reserve asset, and have instead been stockpiling gold. This is what we saw in the chart just now. China, Russia, and India have all been significant buyers, as have many smaller independent nations eager to remain outside the US China conflict. So, foreigners, foreign investors, foreign central banks, they're a little nervous. They don't want to go as all in on the US Treasury side of things as they normally would have. So, as a substitute, they've gone into gold. And that's where the bid comes from. And as gold goes up, naturally, it's little brother, little sister, whichever way you want to look at it, silver comes along for the ride. Observing how the United States imposed financial sanctions on Russia following its 2022 invasion of Ukraine, many countries have concluded that dependence on a dollar-dominated financial system is too risky. They fear that the U.S. government may weaponize the dollar system via financial sanctions or trade policy, and they're seeking alternatives. Shifting from treasuries to gold and other metals offers a hedge. A prominent example of efforts to reduce reliance on the US dollar is the development of alternative currencies, partially backed by gold reserves, such as those being pursued by BRICS. So, for all these people calling silver a bubble, gold a bubble, I don't think those people really understand what's going on. Gold is not Bitcoin. Gold is not Ethereum. Neither is silver. There's something much greater at play here. This is a shift in global world order that's happening, and I just don't see it reversing. And I think that's how many world leaders see it as well. We're not going back to the old days pre 2022. It's like when you cheat on a spouse, or when a spouse cheats on you, trust is lost forever. You could always rekindle things, I guess, but you're never going to get that lingering thought out of your head, in the back of your head, that thought of betrayal. So, genie's out of the bottle, my opinion. I don't think we're going back. And I think this is what makes this gold and silver trade different from the one in 2000 and 2011, which was precipitated by a rising China. Remember, China was rising. It was consuming all these commodities. Commodity demand was rising. The precious metals thereby rise in due course. I don't think that's the case. Beyond geopolitics, let's continue on. Beyond geopolitics, foreign central banks are concerned about the deteriorating credit condition of the United States, which has been downgraded by all three major ratings agencies. The federal government holds more than $38 trillion in debt, growing by trillions each year, which cannot be realistically repaid except through issuing more debt. Yep. Heavily indebted governments have few options other than allowing inflation to erode the real value of their obligations. The United States cannot default outright, as the dollar is the global reserve currency, and tax increases have political limits. Inflation then becomes a hidden tax, steadily undermining the dollar and diminishing household wealth. A new generation of Americans has now experienced the most painful effects of inflation firsthand. Since 2020, the dollar has lost more than 20% of its real value and over 40% since 2000. The lesson of inflation, once internalized during the 1970s, had been largely forgotten after decades of relative price stability, but it's once again relevant as people around the world lose confidence in government-issued money, paper IOUs, that lose value annually. Gold and silver, long regarded as hedges against inflation, are resuming their traditional role as stores of value amid geopolitical, monetary, and economic uncertainty. Isn't that interesting? They talk about this, not to get off track again, but they talk about these 4-year cycles in Bitcoin where, you have like this 1 year, I think it's like the second or third year of the Bitcoin halving cycle where the price goes in the red in the for the year. Well, it actually went in the red before that this year. If you went by the Bitcoin halving cycle model, we were supposed to end the year green this year, but it's actually red, which is interesting because you've entered this period where countries and foreign investors, investors in general, are just looking for a neutral asset to safeguard them from inflation, confiscation of their assets, et cetera. But they're not going to Bitcoin, which a lot of people like to coin digital gold. But Bitcoin actually lost this year. It was in the red. They're going to gold. They're going to silver. They're even going to platinum. They're going to palladium. They're going to copper. They're going to lithium. They're going to rare earths. Yep. Rare earths, lithium, copper. All of these, even these base metals are breaking out. It's not, here's a dirty little secret, guys. It's not just the precious metals breaking out. It's actually the base metals too, but it's being kept hush hush. I think lots of smart money people are accumulating in the base metals sector right now. You could see it. I mean, we could look at them if you want. We could look at REMX, the rare earth metals ETF. You could look at LIT, the lithium ETF. They're all breaking out right now in conjunction with precious metals. So that kind of tells me it's not just a precious metals thing. This is a commodities thing. This is a commodities trade. And you know what? What the hell? Let's go ahead and take a look at it right now since I did mention it. It's fresh in your mind. So here's REMX. This is rare earth metals. This is the ETF for that. And I'm going to switch it over to a candlestick. And we are going to look at it from a 1-year candlestick perspective. So that was in 2025. So we had how much did we run, guys? In REMX, 90%. We actually beat gold. So rare earth metals actually outperformed gold this past year, but you haven't really heard much of it. This might be, yeah, there you go. There's the breakout. You see that? Rare earths breaking out. Take a look at lithium, which is also a base metal. That too, broken out from a 1-year time horizon. You'll notice we're actually up like what? 70% on the year, about pretty much in tandem with gold. But again, you don't hear about that. What else did I say? Lithium, copper. Well, copper's at an all-time high. Let's take a broader look at copper. Yeah, copper, boom. Clear breakout right there. It's gone to the moon. But again, you don't hear about that either. So precious metals are leading the way, and they may be the best performers. I don't know who's going to be the best performer. But the fact that the base metals are now rallying in secret and in silent tells me that this is something, it's not just a monetary story. I think all commodities are being repriced, are going to be repriced. I don't think it's going to be isolated to gold and silver and platinum. So you might want to look into some of these other base metals too, guys. I mean, this is like buying gold and silver maybe in 2020, in early 2025. So the only thing that hasn't run yet is energy. But today was interesting. I actually made a post about it. I think we've covered pretty much we're almost done with this article. So we'll look at energy here in a second, but energy may be the next in line. And that's typically how these commodity markets work, is that gold and silver, gold runs first, then silver gets a bid, check. So we're past that stage, or those two stages. After that, copper gets a bid, check. It's already making all-time highs. After that, the rest of the base metals complex gets a bid, check. We're starting to see that with lithium and rare earth metals and nickel and all these other ones. And then energy gets a bid. So energy, still early. So if you're looking into potential early stage investments, that could be one. In my opinion, not financial advice, of course, but maybe point your attention there. And of course, if you want to get a good list of energy companies, I recommend my good friends over at Capital's Exploits Insider. It's my #1 newsletter of choice. And we do have a special link in the description box below. Get $1,000 off your subscription. And I've been using them for 5-6 years now. They've got a number of portfolios, a huge selection of energy stocks that they've accumulated, all super high value stocks that, if my thesis is correct and energy begins ripping, I mean, those stocks are going to go parabolic, and no one's talking about energy. So that could be an opportunity. We do have a special link down below. Get $1,000 off. Check it out in the description box below. So let's go ahead and wrap up this article. Retail investors are also part of this trend, purchasing both gold-backed paper assets and physical bullion. In the third quarter of 2025 alone, tons of metal held by U.S.-based publicly traded gold ETFs increased by 160%. In the first half of the year, 95 million ounces of silver flowed into silver-backed funds globally, surpassing the total of all of 2024. Costco and other retailers now offer gold and silver coins to a growing number of households, many of whom previously saw no need for anything beyond dollars in their pockets or savings accounts. Gold supply remains constrained due to high production costs and limited new mine development. Meanwhile, silver and platinum have faced multi-year supply shortages, though for different reasons. These imbalances are unlikely to ease anytime soon, except in the case of global recession. With the United States and other nations designated these metals as strategic resources, pressure is mounting to develop new domestic sources, a multi-year process. In the meantime, stockpiling is accelerating. Don't expect the metals rally to end soon as the underlying drivers remain intact. Boom. What did I say? And I did not read the article beforehand. And I do that on purpose so you can get a genuine reaction from me, by the way. While price gains in 2026 may not match 2025's dramatic surge, these commodities are still poised to advance, assuming additional interest rate cuts from the Federal Reserve and other Western central banks, and ongoing government failure to rein in deficits and debt. Investors concerned about inflationary effects of loose monetary and fiscal policy will likely persist. This will continue to support gold, silver, platinum, and other commodities and real assets that preserve value against fiat currency. So there you go. So yeah, as I alluded to today in one of my tweets, and if you haven't followed me yet, it's at CapitalCosm on X. Be sure to give me a follow, guys. I've not been active on my Twitter for a long time, but I have been active the last couple of weeks. And I do anticipate being more active for the remainder of for 2026 and beyond. So follow me on X at CapitalCosm. And it's the one with 4,500 followers. Don't follow any of these impersonator accounts. 4,500 followers. Hopefully we can get that to 10,000 by the end of the year. We'll see. So let's go ahead and take a look at this first tweet here. This is from Gold Silver HQ. $3,000 silver. I'll be happy with $450, but wouldn't complain. Only God knows silver's true value. One thing is for sure, it's a lot scarcer than most people think. So let's see what this is in reference to. Oh, so this is in reference to a Michael Oliver interview. Did he say 3,000? Because I interviewed Michael. I've never heard him say 3,000. I've interviewed Michael many times over. I've never heard him say 3,000. Let me know in the chat, guys. Let me know in the chat. I'm reading some of these comments here really quick. You guys are hilarious. Let me know in the chat. Did Michael Oliver call for $3,000 silver? So what is this? Leading diagonal breakout measured move target. So the cup and handle measured move target, this is the one we've talked about before. That takes you to around, $300, $400. The leading diagonal breakout measured move target. What are they talking about? Leading diagonal. Let me pull up the chart here, see what they're saying. Leading diagonal. Are they talking about this? Did this go all the way out to 3,000? No, there's no way. Yeah, that slope doesn't go all the way up to here. Maybe they're talking about this? Something like that? Yeah, I don't know. But supposedly there's a $3,000 price target. But again, who knows where this we are heading into a system reset. So we'll see. All right. So we've got a super chat from NMCT 2330. Thank you for the super chat, my friend. True value is 200 billion to 400 billion. $4 trillion market cap is from all silver mined since 3000 BC. That's the other thing with silver. Like, I'm reading these market cap figures. Let's go ahead. Let me pull it up. Market cap, assets. Okay. So yeah, they've got silver at 4 trillion. So, but here's the weird thing about calculating a market cap for silver. Silver gets destroyed. So say you've got, I'm just making up numbers here. I don't know. I'm just going to say, like, for the sake of simplicity, say you've got 1,000 ounces in the world. Again, I'm just making numbers up just for the sake of simplicity. Let's say you've got 1,000 ounces or 1,000,000 ounces in the world. And you've got a market cap of, or you've got a price of silver of $100. So that would be $100 million market cap. But if those 1,000,000 ounces, if half of them are destroyed throughout the year, you're reducing your supply of silver. So your market cap doesn't make, you see what I mean? Like, it doesn't make sense to calculate a market cap on the basis of what's available today, because we don't know how much silver is, or we don't know to a precise degree perhaps how much silver there is available today above ground. So a lot of it gets destroyed. It's not recycled. But be that as it may, supposedly we're at $4 trillion now. Well, we've been at $4 trillion, and we're still holding strong at that number 3 spot, but we will come for that number 2 spot eventually in a video. So watch yourself. All right, let's see what else we got here. Uranium was high today. Any uranium investors in the house? Unfortunately, I sold my uranium stocks last year. Yeah, I know. I sold my uranium stocks last year. I held from 2020 up until last year. I got a pretty decent profit. Kind of wish I didn't sell now thinking about it, but I was able to get into, I was able to buy more gold and silver mining stocks and some oil stocks that are up, they're up too. But yeah, I mean, this is from Nostradamus. Some of the big names that are up today. Global Atomic up 23%. I don't know if you guys can see this. MGA up 20%. SUU up 20%. UUUU. Energy Fuels up 14%. Man. Encore Energy 13%. Denizen Mines 13%. This is all on a single day, guys. The URNM ETF was up 10% today. I mean, that is insane for an ETF. Yeah, so here's some more uranium news. Yeah, uranium went bonkers today. So I don't know. Uranium might be one to watch out for in 2026. Let's do a quick checkup on uranium. This channel actually started off as a uranium investing channel. I don't know if you guys know that from the early beginnings of it. So here's the uranium URNM and the uranium ETF URNM. And we're just bouncing up and down from this channel. And we had an all-time high in October of 2025. I got out around this level. And I got in somewhere around here in 2020, April, late summer, early fall of 2020. So I rode it pretty high. But I wonder if I got out too early. I don't know. I guess we'll have to wait and see. But yeah, uranium might be one to keep an eye on. This is from me as well. So the coal ETF was up to 2.2%. OIH, the oil services ETF, was up 3.9%. And URNM was up 10%. And what's interesting is, zoom in so you can see this better. What's interesting is that OIH has actually been outperforming oil. So here's the oil service ETF. Is this a sign? I mean, yeah, this is pretty gnarly. This is on a 1-month candlestick for OIH, the oil service ETFs. And there's definitely something there. There's definitely momentum there starting to show. This thing isn't anywhere near an all-time high, but I believe it outperformed oil or began to outperform oil in 2025. So as oil continued its getting pummeled into the ground. Yeah, so here's your chart for here's the 1-year chart. So OIH is the candlestick chart, and the price of oil is your white line. And there was a divergence somewhere in August. So is this smart money piling up into OIH, into the oil service companies because they're betting on higher oil prices in the future? I don't know. I've got a lot in oil service companies too. So we'll see. And if you chart OIH, actually I have it here. Yeah, so here's OIH priced in oil. And you'll notice we were in this downtrend since May of 2016. Broke out of it, been moving sideways here for the better part of 3 years or 2 years. And we broke out in October. Maybe do these charts, these lines a little better, something like that. And boom, breakout. So OIH could be an early warning indicator for higher oil prices down the line. What do you guys think? Again, guys, be sure to hit that like and subscribe if you're getting value out of this content. Let me know what you think. Hitting all the buttons on YouTube does help in pushing this stream out to more people. So if you'd like to help me out in that regard, then I'd appreciate it. But again, you don't have to if you don't want to. It's all up to you. All right. Oh, this was from Marty. So this is from Martin Armstrong, who I'm interviewing on Monday, by the way. So be on the lookout for that interview on Monday. And he's interesting post. He said the risk gold and silver now face is capital controls. Excuse me. To shut down the flight of capital. This is why platinum is starting to rise against gold. For at least platinum has never been the subject for capital restrictions. Interesting. Capital controls. So I'm going to ask Martin to expand on that. Are they going to go door to door and confiscate people's gold and silver? Will they not do so for platinum? I wonder what he means by that. But yeah, platinum is also killing it. So Maybe if you don't have any platinum, it may not be a bad idea to get some as a hedge. And again, Bullion Standard Pro membership, you can also buy platinum. So link to that is down below. The special promo code for COSM10. This one's another good one. Warren Buffett may have beaten the S&P 500 this century, but all he had to do was buy gold, and he would have done even better. So this is over the last, well, since the year 2000. Okay, so gold's up 1,500%. The S&P is up 683%. And Warren Buffett's up 987%. So an unproductive asset. Isn't it glorious? An unproductive asset, a shiny rock, beat the Oracle. The Oracle has been slain by a shiny rock. Well, you'll notice here that they were pretty much moving in tandem all the way up until this past year, actually. See this blue line and the yellow line? But gold broke away. I want to say this is most likely, I don't know. Actually, I don't know when this is. But I would guess this is probably after the April tariff sell-off thing is when gold broke away. Oops. Okay. Back to, what did I do? All right. Well, let's see what else we got here. Covered that. Okay. Alleged emergency summit held between JP Morgan, HSBC, CME, and LBMA to keep silver below $75. Posted by Luke Groman. We have our paper versus physical thin red line. Game on. So this is from via MCMCT USA. I guess I'll follow him. Am I following Luke? Yes, I am. So it says here at 1:34 a.m. on Thursday morning, Christmas Day, while markets were closed, 6 powerful figures in global finance reportedly held a 47-minute conference call. The participants included the global head of commodities at JP Morgan, the head of derivatives trading at HSBC, the CEO of the CME Group, a senior U.S. Treasury official, the representative for the Bank of International Settlements, and the chairman of the London Bullion Market Association. No official record or press release was made. The narrator claims a source on the call sent a message at 3:15 a.m. saying simply, they agreed, $75. This is described as an emergency summit to prevent silver from crossing $75, a price level allegedly capable of triggering systemic collapse due to massive exposure in call options. And if you recall, we started off the show talking about that wall that we hit our heads on the other night. They wouldn't let us cross $75 for some reason. Remember? Where's the chart? XAG. Let's turn this off. Let's do the 1 minute charts. 1 minute. Yeah, there it is. $75, that magic number. So I wonder when this post was posted, actually. So Luke has it posted on today. So I don't know. It sounds like it's coming from Asian guy. So, oh yeah, it is. I don't know. Do you guys have any sources to back this claim up? It just seems too on the nose. Let me know. Is this true? Because it just seems like they saw that wall that we just looked at here and then just posted a video after the fact claiming $75 was the level. Like it just seemed ad hoc. I don't know. Maybe I should just trust Asian guy. Maybe he's telling the truth. Who knows? Okay. Yep, we already looked at that. Fed repo going off the charts here, as you can see. But of course, It's year-end window dressing, supposedly. You know, we always close out the year with $75 billion injected into the banking system, I guess. Okay, former JP Morgan exec claims banks are not massively short silver. So former JP Morgan exec Robert Gottlieb, who according to Reuters was named as a defendant in a civil suit alleging precious metal spoofing, has come out swinging against the allegations that bullion banks are massively net short silver. And he says, quote unquote, banks are not massively short silver. If they were, losses would exceed $25 billion. Considering the fact that the too big to fail banks have tapped the Fed's repo window for $94.4 billion in liquidity over the past 2 days, we suspect the bullion banks' silver losses in the OTC market, and this is Ted Butler's research, proved that they are indeed short, not long in the OTC markets, are orders of magnitude larger than 25 billion. So what do you guys think? Do you guys think this guy's telling the truth? This Robert Gottlieb guy? Let me know. Let me know in the comments. Let me know in the chat. Five-alarm fire. Banks tap a repo facility for another $20 billion on Friday afternoon. It appears that we are looking at a systemic banking crisis straight in the face after too big to fail banks took down $74.6 billion in emergency liquidity from the Fed on New Year's Eve. The banks have just tapped the Fed's repo facility for another $19.8 billion Friday afternoon, $94.4 billion in liquidity injections over the New Year's holiday weekend. It appears we are about to discover why the Fed quietly removed the $500 billion daily cap on its standing repo facility in December. We wrote on Christmas Day that if silver was allowed to gap up to $80 an ounce to match China's silver price, it would detonate the bullion bank's short silver. Last Friday, as silver skyrocketed from $71 to $79 an ounce and the Fed's repo facility was tapped for $17 billion, we asked whether one of the large bullion banks' silver shorts were being liquidated after reportedly being unable to make a margin call. Based on the events at the Fed's repo window, as this week has progressed, it's starting to look like we are witnessing the fallout of that detonation from behind the curtain in real time. Oh, this is another big story that came out past day or so. Chinese ports have begun refusing to ship silver cargoes to delivery warehouses approved by COMEX. Beijing reportedly rejects 50 million ounces of U.S. silver order. Yeah, we cover this in the interview tomorrow. That's supposed to be posted tomorrow with Eric Jung and Francis. So be sure to tune into that one, guys. Let's see. I think that's it. Any new updates on X? Let's see what we got here. Yeah, there he is. Star of the show. Silver's new normal should be $200 plus. Well, I don't think you'd have many disagreements with that. I guess Grok is pretty smart. Okay. Silver is overbought. In other news, here's 50 years of silver versus the Dow. See that little green bar here? That's the silver move that we saw this year in the grand scheme of things. Granted, it's on a linear scale, but still, it gives you an idea of the sheer magnitude of under allocation of silver relative to the S&P, or silver relative to the Dow, or silver relative to the broad markets in general. And all that capital that's in the broad market, not all of it, but a fraction of that capital, and it's huge. It doesn't even have to be half of it. It doesn't have to be a quarter. A fraction of that capital coming over to the precious metals complex. Boom. What more do you want? So this is from Vince Lanchi. Silver's most hated rally ever. Next time someone tells you silver is being driven by speculative froth, show them this chart from between two beats. Translation, banks covered shorts in the first leg. It's all physical. So we've got silver futures here in green. The moving average here in black. Daily OY. Yeah. So anytime this spikes up, looks like, what does OI stand for, guys? Open interest. Sorry. Alzheimer's moment. Open interest. So anytime this spikes up, you're seeing it spike up in open interest. And yeah. There you go. Yeah, there it is. There's that red line we weren't allowed to cross, that $75 boundary. Yeah, check that out. It's like someone mowed the lawn. It's so nice and crisp. Okay, I think this will probably be the last post we read. We read, meaning a little tired, as you can tell. Silver short squeeze is here. We are witnessing the greatest potential short squeeze in financial history, while the charts show silver at $71. The real street price is already trading above $130 globally. Why the gap? Because the banks took massive short positions before the recent pump. Now they are burning through liquidity to defend the $74.50 liquidation price. They can only hold on for so long. If silver crosses that price, billions worth of short positions get liquidated instantly. This is a GameStop versus Wall Street situation on a bigger scale. Retail investors control the physical supply. The banks are running out of ammo to suppress the truth. Do not sell. We have them cornered. I think we're going to cap it off on that. Anything else? Yeah, no big news. I think that pretty much covers everything. So that's it, guys. Hit that like and subscribe if you don't mind. I do appreciate your time. Again, if you want to add into your stack, consider becoming a member at the Boolean Standard Pro. You see the savings right here on the screen. It basically pays for itself. So if you are in the market, consider picking up a membership and save yourself a ton of money. No strings attached. It's quite simple, actually. So link is down below. Use promo code COSM10 at checkout to get 10% off your first month. All right, guys. Thanks for watching. Good night.